New study supports 100% equity investing for life. A new high-quality study was just published, and it challenges two conventional wisdoms of investing. One is that savers should diversify between stocks and bonds, and two is young people should invest more heavily in stocks than when they are older. These are very widely believed conventional wisdoms. The study showed that overall, the all equity strategy that they recommend beats conventional wisdom in achieving both retirement goals of long-term appreciation and capital preservation. Okay, so what we're going to learn today is this new study a high-quality study? What does the study prove? What's the effective way to diversify? In what two ways is diversifying with international stocks better than with bonds? Why should investors keep the same allocation to stocks as they get older? Is the all-equity strategy safe? Should we actually invest 67% into international stocks? What studies already on my blog agree with this study? Okay, so first, is this study a new high-quality study? So the study is titled Beyond the Status Quo, a critical assessment of life cycle investing advice. I have a link to it on my blog. It was just published on December 6th, 2024 by finance professors Aizen Anurkalova at Emory University, Scott Cederberg at University of Arizona, and Michael O'Doherty at the University of Missouri at Columbia. This study improves on past studies by looking longer term over the time of a typical retired couple, by fixing issues such as survivor bias, and by including long-term data from 39 different developed countries. So not just the US, as a lot of other studies, and it's fixed up a lot of these prior data errors. So what does the study prove? The study shows an optimal lifetime allocation of 33% domestic stocks, 67% international stocks, 0% bonds, and 0% bills vastly outperforms age-based stock bond strategies in building wealth, supporting retirement consumption, preserving capital, and generating bequests. Okay, that's a direct quote from the study. So in other words, 100% equities with 2/3 in international stocks has been far better than the two conventional wisdoms that I mentioned in providing high growth, higher retirement incomes, and more reliable retirement incomes. So now, what's the effective way to diversify? So investors should prefer international stocks to bonds for diversification. Bonds offer modest average real returns, like 0.95% annually, compared with international stocks, which are 7%. So it's 7% over inflation rather than less than 1% over inflation. So that would necessitate strong diversification benefits to make bonds attractive. This again is a direct quote from the study. So at short horizons, bonds appear less risky with lower standard deviation, that's a risk measure, of 9.1 versus 23.3, and lower correlation with domestic stocks, so 0.21 versus 0.33. But at long horizons, the picture changes. Bonds per period variance increases. It's 2.3 times higher over time than a 1 year. Meanwhile, international stocks decreases to only 3/4 of what it is. So international stocks get less risky as time goes on. Bonds get much more risky. The correlation of bonds with domestic stocks rises to 0.45 which is relatively high at 30 years, whereas international stocks remain a steady correlation at 0.5. So bonds get more and more correlated as time goes on. International stocks also help preserve real buying power with a low correlation with inflation, so negative 0.01, basically zero, whereas bonds do not, negative 0.78, so which means they go very much the opposite of inflation. Bonds ultimately seem unattractive for long-term investors. They have low returns, high long-term variance, that's risk volatility long-term, high long-term correlation with domestic stocks, and high exposure to inflationary periods. In other words, bonds have a minimum return after inflation, offer long-term diversification, like low long-term diversification, are much riskier over long periods than short periods, and get killed by inflation. So here's another quote from the study. The optimal allocation avoids fixed income investments and chooses an all-equity strategy. This result may seem surprising given the vaunted diversification potential and safety offered by bonds. However, bonds become riskier and more correlated with domestic stocks as the investment horizon grows. The optimal allocation reflects the superior diversification benefits and growth potential of international stocks. That's a direct quote. All right. Now, in what two ways is diversifying with international stocks better than bonds? So, number one, the all equity strategy dominates the two conventional wisdom with 50% more retirement wealth on average than a balanced strategy and 39% more than the target date funds. Target date funds are about reducing equity allocation as you age. So, this additional wealth generates a large stream of income for retirees. In other words, international stocks are much higher return than bonds. For a couple saving 10% of their income into all equity portfolio to have the same retirement, they must have 19.3% of their income with a balanced strategy, nearly twice as much. Target date funds need to save 16.1%, so that's 61% more pre-retirement savings to provide the same retirement. So you can invest way more with these conventional wisdoms than with the all equity portfolio. Note the study refers to target date funds as life cycle investing. Okay, this is the conventional wisdom of investing more in bonds as you age. It's completely different than life cycle investing strategy on my blog, which is the ultimate investment strategy for young people. So don't confuse the life cycle investing strategy with this life cycle investing they're talking about here. Okay, number two ways that the international stocks beat bonds for diversification. So a surprising result is that the all equity strategy also beats conventional wisdom in capital preservation. So households allocating 33% domestic stocks and 67% international stocks are much less likely to exhaust their savings. Under the common 4% rule for retirement spending, a couple using the balanced strategy has a 17% chance of running out of wealth. Target date funds are worse at 20%. In comparison, the probability for the optimal all equity strategy is low at 7%. So you're much more likely to make it through and provide for your entire retirement with an all equity strategy. So, and I have a chart on my blog that actually shows this. They call it the ruin probability, and you'll see how much lower the risk is with the all equity strategy. So why should investors keep the same allocation to stocks as they get older? Here again, a direct quote: "There is no economically meaningful gain from holding bonds at any point during their retirements. The long horizon return data suggests that diversifying with international stocks rather than bonds improves investor outcomes for long-term appreciation and capital preservation." So note the ruin possibility is far lower with the all equity portfolio. Now, is the all equity strategy safe? Now here again, direct quote from the study: "Drawdowns can inflict intense psychological pain, and one worry is that some investors will abandon their investments rather than stay the course. Contrary to common intuition, however, conventional wisdom with large bond allocations carry the potential for even larger drawdowns in real terms. So after inflation, you got a much higher risk with bonds. These strategies also expose investors to greater risk of exhausting their savings. So in other words, bonds are less reliable for a 30-year retirement because they get killed by inflation." Another direct quote: "Our results as a whole do not suggest that the all equity strategy is safe. They merely suggest that it is safer than common alternatives. Given the relative safety and strong growth potential of equities, retirement savers and retirees would likely benefit from adopting a set it and forget it strategy that fully invests in domestic and international stock." Okay, now, should we actually invest 67% into international stocks? So now this is actually kind of interesting. So the study looks at 39 developed countries altogether. So having 33% in domestic stocks is the best allocation on average for all the countries. So they're suggesting this international stocks, no matter which country you're in, you have 33% in your own country and 67% outside. So I'm sure this optimal allocation would be different for different countries if they actually ran it for each one. So, for example, some countries like Chile have negative returns during the study, the entire period of the study, while other countries such as Czech Republic, Finland, South Korea, Norway, and Mexico have returns between 7 and 10% per year above inflation. So you'd expect the country with a stock market that declines over years to have a lower optimal allocation to its own domestic stocks than countries with high long-term returns after inflation. So investing 33% in your own country when the stock market declines over many years is not an effective strategy. So I've read blogs from American investors wondering why they should invest 100%, why they should not invest 100% in the U.S. The U.S. stock market has significantly outperformed the rest of the world the last several decades, and U.S. stocks are now 74% of the world index as of today. So growth in the world is mostly in a few countries, including the US. So the study says that diversifying with international stocks is much better than diversifying with bonds or cash. We also only have 150 years of good stock data, so being all in one country is probably a higher risk. So the portfolio manager we work with actually has almost nothing in Canada, which is, the domestic. So Canada is only 3% of the world stock market and is a lower growth country. So this portfolio manager, they invest globally to get broad international diversification. Recently, they've been more heavily focused in the U.S., so they get the international diversification, but they don't fully follow this. But they get the broad diversification, but not with 2/3 of the U.S. What studies already on my blog agree with this study? If you've been following my blog or YouTube channel, you'd know I've seen through these common conventional wisdoms for many years. Unconventional wisdom works. You would have seen the charts from the study by Professor Jeremy Siegel in his book, Stocks for the Long Run, my study of the long-term returns of the U.S. stocks, and my 4% rule study. These studies and these charts agree with a new high-quality study. So the Stocks for the Long Run chart shows how much stocks outperform bonds and cash, how much more reliable they are in this 200-year chart. This chart, you see stocks, you see the growth is massively better than bonds over 200 years. And notice this, the line of stocks, these are after inflation, is pretty straight compared to inflation, while bonds is much more erratic. So now the Stocks for the Long Run, the book also shows how stocks have been more reliable than bonds after 20 years or more. So the chart I've had on my blog a few times shows this is the risk level, a picture of risk. And stocks are much more risky at 1 and 2 and 5 years periods. But once you get to 20 to 30 year periods, stocks are actually more predictable than bonds. I accumulated the history of U.S. stocks for 25 rolling periods to show how reliable they've been long-term. And so this 25-year rolling return, you see it's always been above 5% for the U.S. And in the modern stock market, this is about 1930, it's basically always been above 8%. So it's been reliable as a long-term return. I did an in-depth study of the actual results of the 4% rule over 30-year retirements in history. This colorful chart is the actual 30-year history with 100% in equities. It shows that it has had a 96% success rate in history, and almost all retirements ended with more after 30 years of retirement than when you retired. Again, I had this chart on my blog before, but you notice that this is with no management of it, just taking out 4% of your starting retirement portfolio every year and increasing by inflation. It's basically always survived, and it would have always survived with a bit of management. So my 4% rule study also shows how adding bonds has resulted in higher, not lower risk of running out of money compared to the all equity investing during retirement. So the chart shows, as you add bonds, it always gets less reliable, not more reliable. All right, that's my talk. So what we've learned today is this new study a high quality study? What does the study prove? What is the more effective way to diversify? In what 2 ways is diversifying with international stocks better than with bonds? Why should investors keep the same allocation to stocks as they get older? Is the all equity strategy safe? Should we actually invest 67% into international stocks? What studies already on my blog agree with this study? All right, so my name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a full-service financial planner. It's just edrempel.com or unconventionalwisdom.ca, but it has to be .ca with unconventional wisdom because we're Canada. We offer a free 30-minute consultation if you're potentially interested in talking to us. Just go to edrempel.com/talk. Or please, you can subscribe to my blog, podcast, and YouTube. Podcast is edrempel.com/listen. YouTube is edrempel.com/watch. Thanks for listening, and we'll talk to you next week.